everybody, give me just 1 second here. There we go. Let me check the audio, make sure the audio is working okay. Okay, looks like it is. Perfect. On the daily chart, we're starting to build more buying pressure in this general area right here. And we broke below the January the 13th lows, but we're not getting a clear breakout with follow through below the lows. And because of that, that makes me think we're probably going to bounce. Just look at the overall market. This looks like an overall trading range. And because of that, I suspect realistically buyers below scaling and lower, and we'll probably have to test up to the moving average. Therefore, the bulls that bought up here, February 3rd low and more lower, probably will make money. If the bears are lucky, what do the bears want? The bears want to rally in a lower high, and then they want to break below and lower prices. Or the bears just want a downside breakout, but I think that's lower probability. Bulls want a double bottom, and they want a strong reversal up to the December highs. Probably not going to happen, at least immediately. So we have a lot of trading range price action. Now for the bulls, if they get a bull bar closing on its high tomorrow, and then Monday we gap up and form another strong bull bar, that would increase the probability that we're going to go higher. But at the moment, looks like we're going to bounce, and I suspect it'll be a bull leg in what will become a trading range. 5-minute chart. Want to just check something here. That explains that. There we go. So this is the January 13th low. It's important. It's that price level over here. Overall, coming into the day, the market, I'll make the chart a little bit bigger. There we go. The market gapped down on the open, and it got followed through. That increases the chances that we're probably going to get at least some kind of second leg down, and therefore probably sellers above, and will probably fall below the one low. But when you look at bar one, you know you're at support. Realistically, there's probably buyers not all that far below. And then bar two, we broke to the downside and reversed up. Does this look like the start of a bear trend from the open? Or what does this look like a trading range open? To me, this looks more like a trading range open, and it increases the chances that we're going to be sideways for several bars. Outside down below 3. Let me turn on the bar counter. That would probably be helpful. There we go. Outside down below 3. For the bears, it's the second leg down after 1 and 2. Outside bars are expanding triangles, and when you have an expanding triangle at support, yesterday's low, the 27 low from yesterday, really the 28 low. You can take the sell for a swing, but realistically, it's not all that great of a trade. You will have some traders sell and scale in, but bar 3 has a lot of overlap with 2, and I suspect there's buyers below. 4, bull bar, good for the bulls, second entry buy. What about buying it? Well, it's the same problem we've had on the open. If you're buying in the middle of what's likely to be a trading range, and therefore the market may not go straight up. Instead, it may get a second leg down below 3, or at least test the 3 close. 4, bull bar, but what do you notice? Does that look like a great entry bar for the bulls? Not necessarily. And therefore, you can see the market rallied up to 4 and pulled back, and therefore some bulls and bears will both be selling. Bulls selling out of longs, bears selling to go short. 6, bear bar closing on its low. It's low one short, breakout, pullback, sell after 4. But 5 is a disappointment bar. It's not a great stop entry for the bears, and therefore there's probably buyers below 5, buyers below 6, scaling in lower, and we'll probably test the 5 high. 7, bull bar, second leg up for the bulls. Good for the bulls. What about selling it? Betting on a wedge, 1, 5, and 7. 7's a breakout of a tight trading range, and it's a little bit of a surprise. And we also have targets above the moving average, and therefore it increases the chances that the market may go higher. 8, follow through, but we have a tail on 7, tail on 8. That's a warning that this could be a bull leg in a trading range. But as far as selling the close of 8, no way. It's consecutive bull bars, and that increases the odds we're going to get a second leg to the upside. 9, and is that an inside bar? Let's see. Okay, an inside bar on 9. Good for the bulls. Increases the odds. Inside bar 9 increases the odds that it might be a final flag. But as far as selling above 9, no, it's tight. For one, it's a breakout and you're getting follow through. If we break above 9, it increases the chances that we have to test the 9 high. But as far as selling, I think it's not worth it. 10, follow through for the bulls. Tail above the bar. We're losing momentum, testing the moving average, but it's a micro channel from the 7 low. And therefore, it's still by the close and scaling lower. And then 11, bull bar, but a tail. Is it a wedge, parabolic wedge? 8, 10, 11. I don't think it's all that great of a parabolic wedge. Makes me think that any reversal we get will probably be limited. And then 12, breakout pullback buy, but a high one buy, so probably sellers above. And therefore sellers above, and there's probably buyers below. So in other words, 12, we may pull back, but I suspect we'll go above the 11 high at a minimum. And we probably are going to go higher. Are we going to go up to the 77 low? We might, but right now this looks like a bull leg in what will become a trading range, and that increases the risk that we pull back. 13, we tried to trigger the buy above 12, and we're pulling back on 13. Probably buyers on the close of 13 or below it. 14, second leg up, good for the bulls. But remember what I said about high ones? We went above 9 for a bar or two, and then we pulled back, testing the bar 9, which is basically an inside bar. It's a pullback. We have 12. It's a high one buy, if you want to call it that. We have 12, high one, and then an inside bar 13. We broke above it. That increases the risk that we test back to the 13 high. 15, consecutive bull bars. Good for the bulls. However, we still may pull back here. Consecutive buy climaxes makes me think that we're probably going to test the breakout point. And then 16, bear bar closing on its low. Good for the bears. Can you take the sell for a swing? You can, but realistically, it's a low probability sell, which means it's probably minor, and traders will probably be quick to scalp out. Follow through 17, good for the bears, but a trend line break. Do you really want to be selling the first reversal down? Yeah, it's a little bit dangerous. Some traders will sell it, and you see what happened on 18. If they sold the close of 18, if they sold the close of 17, if you go back on 18 and really think about the bar actually hesitated. And when it's the longer it hesitated, more and more bears bought back shorts and more bulls began to buy. And that's what caused 18 to close on its high. 18, breakout, pullback, buy. You can call it a high one. We may try and get a small second leg down, but realistically, 18 is a strong enough reversal in what's been a bull trend from the open so far, at least since the 3 low. I suspect we're going to test the breakout point, 15 low, 16 low, and we'll probably get up to the 16 high. And then 19, good for the bulls. 1 second here. $19, good for the bulls. Probably buyers below in a second leg up above 15. And then we got a second leg up, outside up on 20. Outside up on 20, do you buy the close? That's a little bit dangerous. You had a breakout and follow through, 16 and 17. And you have 2 small legs up, 18, pause, 19, second leg up, 20. that increases the odds that there might be more traders selling above 15 and we pull back here. 21, bear bar closing on its low. Good for the bears. Looks like we'll test down. Looks like we'll probably test down to the 15 to the 17 close, even if we have to go sideways for a few bars. 22, consecutive bear bars. Bears want to double top, failed break out of the 15 high, and they want a reversal down, break below the neckline. Tested the open of the day, but probably not going to happen. And then 23, bear breakout, falling below 17. Some bears sold to close the 17, disappointed by the pullback. 18, 19, and 20 getting out break even. For the bears, 23, it's a disappointment bar, but as far as buying above it, you're buying after a 3-bar micro channel. I suspect there's sellers above, and we'll probably get a second leg down. 24, another tail below the bar, so we'll probably bounce. You have trapped bulls who bought the 20 close, disappointed, scaled in lower, trying to get out break even. And you can see what happened. They got out break even on 25. 25, you have a bull bar closing below the midpoint. For the bulls, they'll see it as a double top 18, 24, but 25 is a bad entry bar. They want to break above the neckline 20 and a measured move up. Bears, they'll see 25 as a pullback after 21, 22, and 23, and 24, and they want a second leg down. So the bears, they need the reversal down. 26, bear bar closing when it's low. Good for the bears. It's a bear bar closing at the bottom of a trading range, but it's got a decent amount of momentum to the downside, and therefore, if this starts to get follow through, it'll trap the bulls. You already have some trapped bulls, bulls that bought the 25 low, possibly bulls that bought the 24 low. And you see what happened, 27, it's follow through. Not a strong follow through bar, but it increases the risk of sellers above and a second leg down. 28, more follow through for the bears. Increases the odds we're going to test the green line, the open of the day, and we may end up getting all the way back down to the 3 close. For the bears, bar 3, they never got a chance to get out break even. They sold the 3 close, they scaled in higher, and at best, they were able to get out break even on the entire trade if they sold to close at 3 and they sold more above 3, getting out break even here. Is it sell to close 28? It's probably okay to sell to close middle of the trading range, so you have to be quick. You have to be careful. And then 29, bear bar closing on its low, but sell climax at the open of the day. It's a little bit dangerous to be selling right here, but there's really no reason to buy. 30 consecutive bear bars, 29, 30, good for the bears. Probably going at least a little bit lower. First reversal up will be minor. And then 31, a big sell climax bar. Sell climax bar closing on its low, becoming more parabolic in an overall trading range, probably profit taking. But even if you sell the close of 31, are you in a lot of trouble? No. If you sell the close 31, use a wide stop scale in, odds are high, you're going to make money. Bull reversal bar 32. For the bulls, they want a failed breakout below 3, failed breakout of yesterday's low over here. However, I suspect there's sellers above. This is a strong enough reversal 32. We may get a second leg up and a deeper pullback than what the bulls want. But it's probably a minor reversal. And then 33, bear bar. The bulls couldn't even trigger the buy, and that's because there was too many bears selling. 33, low 1, so we may pull back, and we may find buyers below 33, meaning this bar, it's a low 1. We may pull back to the middle, upper third of the bar, and then get trend resumption. Why would we get trend resumption? Because low 1s typically pull back and get trend resumption, especially the stronger the trend, the stronger the selling in this case, the more risk that the low 1 gets immediate follow through. And bull bar 32, second entry buy. Can you buy above 32 betting on a swing? It's not that great of a trade. You had bulls who bought the close or tried to buy above 32, and on 33, they never got a chance. And some of those bulls are trapped. They bought the close of 32, front running the buy, and then on 33, the market went straight down. And therefore, if you bought the close of 32 at the market, you got trapped into a losing trade on 33. So what are you going to do on 34? You may try and get out break even. And you can see what happened. It allowed the bulls to get out break even. Bulls that bought above 34, some of those bulls, as the market rallied, they quickly began, once the bar rallied and started to pull back, they started to sell out of longs. And then the bears, they started to do the opposite. They started to sell to go short. Breakout pullback sell below the 34, 35 low, basically a low two. We rallied on 32, pulled back 33, low one, the first attempt to resume the trend. We rallied 34, 35, and we tried to resume the trend again, 30 on 35. The other thing I forgot to mention is low ones, they typically pull back and get trend resumption, and therefore the odds are high. You sell below 33, you sell more higher, probably going to make money. Trying to find an example here. Anyways, you get the overall logic. Kind of like this. You buy above 37 and then you buy more lower and you are able to get out break even at your first entry. That's an example of a high one. Follow through 36 for the bears. It's a bear breakout below the low two and the tight trading range. Good for the bears. Tail below the bar, so we may pull back and test the 35 low, but the channel down is tight and therefore buying the close of 36, while it'll probably lead to a test of the 35 low, the breakout point. In general, when the channel is tight, it's better to only look to sell or sell pullbacks. 37, we went above the breakout point 35, and we went above 34. Bulls that bought above 34 and bought more lower were able to make money. They buy here, scale in, make money. Why? Because we're in a channel. And then we got a bear bar on 38. For the bears, they'll see it as a wedge. 32, 36, 38. Channel down is tight. Not ideal, but probably buyers below scaling and lower. And you can see 39 reversed up again. So we keep getting multiple reversal attempts, but we're not getting bull bars closing on their highs. And that's a warning that something is not quite right here. 40, bear bar closing on its low. Good for the bears. Bear breakout below the bear channel. Should you buy the close? Well, the problem with it is it's a bear break out of a bear channel in an overall trading range environment. And therefore, the other thing is every time we get a new low, the breakout point gets closed. So bulls that bought the low of 35 and buy more lower, odds are they're probably going to make money. And then they got a reversal up on 42. For the bulls, they'll take the buy for a swing, stop below, 41. They'll buy above it. For the bulls, they'll buy above 41, stop below 40. And if you get stopped out, you look to buy again. And 42, reversal up, good for the bulls. Probably going at least a little bit higher, but we had a spike pullback channel, and we're in the upper third of the channel, and therefore this is a trading range, and we're in the upper third of the range. Good bar 42, probably the first reversal down will be minor, and then we got a bull bar. We got a bear bar 43, probably buyers below. Bulls that bought the close of 42, disappointed 43. They'll scale in lower, look to get out break even. For the bears, as far as selling below 43, I'd rather wait for a micro double top at a minimum. And then Doji 44, really not ideal. You can see some of the bulls that got out on the bulls that bought the close of 42, disappointed 43, got out break even. And then we tried to break below 44, but we could not, and we reversed up 45. 45, bull bar closing on its high, probably going to go above the 42 high. And therefore, as far as selling above 49, I would not. And we're probably going to get to the moving average. And you can see we got a second leg up above the 42 high. 46, good bar for the bulls. Is it sell to close because it's at the moving average? It's 2 legs up, but to me, it's really, I don't think it's all that great. To me, we're forming a trading range from basically the high of 35 to the low of 40, bar 40. We're in the upper third of the range, but we have an overall possible trading range day here. And therefore, we may have to get closer to the moving average. And then we got a doji on 47. For the bulls, they'll see it as a 3-bar micro channel. They want a bull breakout of the bear flag, 40 low, 42 high. But to me, 2 legs up at the moving average. 47 is important. It's hesitation and a loss of momentum after 46, and that's a reminder that there's profit taking at the moving average and traders selling. Why? Why is there traders selling? Because if there was a lot of traders buying after 40, there's profit taking at 47 and traders selling. Why is there traders selling? Because if there was not traders selling, when we see a bar like 46, 47 would be another big bull bar. And then 48, bear bar closing on its low. Good for the bears. Reversal down after a tight bear channel. Probably going to get a second leg down. As far as selling the close, you can sell the close taking a chance that we'll get a second leg, or you can wait and see what the follow through looks like. And the follow through was a doji. That doji bar, minimum follow through for the bears, probably sellers above in a second leg. So you'll have some traders selling the close of 49, betting that at a minimum it will attempt to get at least a small second leg. And then you can see 50, bear bar closing on its low. Good for the bears, but bottom of a trading range. If you sell the close of 50, you might get something like 51, which would increase the chances of traders taking profits. But 47 to 51 is a micro channel, and there's probably sellers above 51 scaling in. Because we're in a trading range, breakout points are closing, and we have a breakout point below 49 and breakout point below 47, and therefore 51, I suspect will probably test up to the 49 doji low and close the gap. And that's what happened with 52. 52, bull reversal bar, not a good sell below the bar, so probably buyers below it at least a little bit higher. Testing the breakout point 48. 3-bar micro channel, but tail 52, tail 53. Probably buyers below, but I suspect we'll probably test down to the 50 close and allow those bears to get out. 54, bear bar, but again, while I think there's buyers below, the pullbacks will probably be deep. And you can see we started to go sideways here. We're starting to form a more credible bottom. Bulls, they want a higher low major trend reversal, bear trend line break to a lower low major trend reversal, 51, and then a higher low major trend reversal on 56. But 56, not a great buy. It's following a big bear bar 55, and we may have to fall below 55 and get another leg down. And that's what happened with 58. Now, if you bought above 56 and you put a stop below 57, you have to ask yourself, what's the chances that if a trader buys above 56 and buys more below 56, that they're going to make money? Well, it's trading range day. And surprise, surprise, they're probably going to make money at some point. You had a bear bar below 58, closing on its low, and we got a second leg down on 60. However, look what happened. 60 broke below 51, and now we have a doji. Does this look like the start of a collapse? No, it looks like a bear leg in what's going to be a trading range. And you can see we reversed up 62 and 63. 62, it's a low one short, but parabolic wedge, 56, 59, and then 60. Low one short, it's a low probability sell below 62, and therefore not a lot of traders are going to take it. And because 62 is a low probability sell, that's why 63 reversed up. 63, strong enough reversal. I think we'll probably go higher, and in the minimum, we'll probably get to the 53 high. And then 64, strong bull bar closing on its high. Good for the bulls. Is it by the close? It might be, but you're fairly high up in the range, and you're right above the 57 high. And plus, you have a tail 63, tail 64, increases the odds that we pull back. And then we have a doji 65, probably buyers below. But because we're in a trading range, the pullback could be a lot deeper than what seems reasonable. And then we got a really big bear bar 68. For the bears, you sell it. Well, the problem with selling it is you're selling in the buy zone, and therefore it's a little bit too late to be selling. You will have bears hoping for a second leg down, but I think it's fairly low probability. 66, bull bar, closing on its high. Good for the bulls. You can buy above the bar. But again, you have the issue of the bears wanting a second leg down after 66. And strong enough bull bar will probably get at least a small second leg up. 67, it's a bull bar, 68, it's a bull bar, probably buyers below in a second leg. You can argue they got the second leg 69. We're getting close to the breakout point 65 where the bulls got trapped. So there might be more traders selling above 69 than buying it, and the bears will attempt to get a second leg down. 70, doji, that's a warning that the bulls are not all that eager to buy. 4-bar micro channel, but context really not that great. And then we got a bear breakout on 71, testing the bottom third of the micro channel rally here and near the 66 close. Some of those bears who sold the close at 66 were so disappointed by the rally that they scaled in, and they're happy to get out near the bottom third of the bar with a small loss. Selling below 71, tail below the bar, not ideal. Probably buyers below. And then we got a bull bar 72, and you can see we basically went sideways for the rest of the day. We came close to the moving average, but we could not quite get there. For stop entries, I thought you can buy above 4, and I think it's okay to hold below 5. Obviously, hold below 6. And what do the bulls do if they're long? Well, I think they very reasonable to get out below 16. Bears, they can sell 16, but when you see a bar like 18 closing on its high, I think it's probably better just to exit the trade. Bulls, if they buy 18, where do they get out? They can get out below 21. They can get out below 22. They can get out above a bear bar like 23, 24. They certainly get out below 26. The problem here with 21, you think about it's a 4-bar bull micro channel, and you're thinking, why in the world would you get out below that bar? Well, the reality is we rallied on 18, and then 19 is a pause, and then 20 is a second leg up, and it's a bull breakout late in a rally that had consecutive bear bars, 16 and 17. That increases the chances that we test down in the 17 close. So this is really not all that great of a buy, especially when you get follow through. And then bears, they can sell 26 or anywhere in here. And where do they get out? Realistically, some might get out 34, but the reasons I mentioned, it's not that great of a trade. And then other than that, you probably just get out above a bull bar. So would you get out above this bar for triggers? Absolutely. Follow through 42, good for the bulls. Always in bulls. I think they can buy above 41. I think they can buy 42. And then where do they get out? They probably get out below a bear bar. And that bear bar, if you didn't get out a couple of points below 47, you get out below 48. Aggressive bears, they can sell, betting on a tight bear channel, test to the bottom of the range. They got it 40 on 50. And then where do the bears that sold get out? Some get out a couple of points above 51. Others will just stay short. And then they probably get out, maybe they get out above this bar here, but there's an argument to be made that we need a second leg down after 55. And then they get out above, I would definitely get out above 59 or any of these bull bars over here. And then bears, as far as bear selling, really not a great sell. And therefore, whenever you have a situation where it's not a great sell below bars, that increases the chances that bulls will buy and stay long, betting on a reversal. And then 63, you can buy the close, you can buy above 64, you can buy the close, but you're buying high in the range. And because you're buying high in the range, if you get a doji on 65, like so, that increases the chances. No one's going to put a stop all the way down here. What they're going to do is they're going to put a stop several points below the bar, maybe 10 points below the bar. And in this case, they get stopped out. Bears, if they were quick, they could sell, but we're talking about stop entries here. And selling below 66 is not really that great of a stop entry. Big bar with relatively big risk, and therefore the risk reward is not all that great. And then maybe you buy above 67, not ideal. And I think the rest of the day is really just a mess. By bar 72, some will buy it, but again, not really all that great of a trade. Limit orders, I thought buyers below 5, buyers below 11, scaling and lower. I thought sellers above 12 and 13. But the sellers, when you have a channel this tight, I mentioned that it's really not a great sell above because we're probably going to go at least a little bit higher. And then I thought sellers at a new high of the day. I thought sellers above 24 and above the high bar 20. And then you could argue sellers above any of these bars and also buyers below. I thought buyers below 43, 44. I thought probably buyers below 40 low for a bounce. And I thought realistically buyers below 66 because big bar, big risk. It's a bad risk reward trade. And then, limit order trades through here, but most traders shouldn't take them. Buy the close, sell the close, probably buy the close on 8 for a second leg up, sell the close 27, 28, 29, 30, 31 for a second leg down. And that's probably it for buy the close, sell the close. The others, 49, probably sell the close if you're aggressive. 50, it's not sell the close. It's probably look to sell pullback. And it's really the same thing for all the other trades. Was buying the close of 76 reasonable here? And you can take the buy for a swing, but as far as reasonable, the problem is this: 76, you have 5 bars until the day closes. You can obviously hold the trade for the rest of the session, and if you bought it here and you held, you obviously would have made 1 times your risk. But again, I don't think it's that. Generally speaking, I think anything past bar 72 really isn't all that great. Okay. Last question, I'm going to wrap it up. What do you think the difference between the bull rally of yesterday and today was? So what was the difference between this bull rally here, trading range open, this bull rally, and then here, rally, and then sell off, and then pretty much sideways? Well, the difference was one here, we had a trading range, we got a second leg down from this, and we had a fairly strong reversal. The difference here was we had a big gap down sideways and we rallied, but that's basically like getting a bear breakout and a pullback, and therefore there's increased risk that the rally up to 14 is actually a pullback of the bear breakout. Why did yesterday's rally have a breakout after the trading range bar 52 here, and today had a breakout down? Okay, so why did bar 52 break out to the upside? Because we had a tight bull rally here, and because of that, it was reasonable to buy the close of 42, especially if you're willing to use a wide stop and scale in. And so what I would challenge you to better understand is major and minor reversals. The odds were this bear breakout 44 would likely get a second leg, but it would not. The bears would need to do more than what they have done here. And then bar 26 today. So why did, oh, okay. Yeah, so I see your question. So basically what you're asking is why did this rally here form a trading range and get a bear breakout, and yesterday's rally here form a trading range, get a bull breakout? For one, it's context. Number one, tight bull channel. This bar closed was the first bear reversal of the rally, and it was much stronger. And then the other one here, this was a bull reversal right at the moving average after a gap down, and we went sideways for a lot of bars. So we already had a reversal attempt on 16 and 17 that went to a new high. This is the second or third reversal attempt here. First reversal attempt got a minor reversal and a rally to a new high, except instead, bulls found buyers. Last question, do I pay attention to a 200-day moving average? I do not. You're probably talking about a simple moving average, but this is a 200-day, at least EMA. Close is close enough. And, I get it. People are saying that, oh, we're at the 200-day SMA, or the 200-day moving average. Again, this is an exponential, but I don't really want to deal with adding a simple moving average on this chart. Yes, you're at it, and therefore there's probably buyers in this general area, which is why, in part, I already think we're going to bounce right here. We may have to go sideways for several bars before we get the bounce, but overall, this looks like a bear leg in a trading range that'll probably pull back. So that's my answer to the, do I look at 200-day moving averages? And the answer is really, no, I don't. So where do we go tomorrow? We have a doji bar, and the bears are losing momentum, and we're far from the moving average. That makes me think that the risk is we're going to bounce. So if we think about the weekly chart, what do we have? We have this really impressive looking bear bar closing near its low. But this is what always fascinates me. We have one trading day left. So we're down here, but on the daily chart, we're a little bit extended, and therefore there's increased risk. What if tomorrow rallies up here to 53? So what if we go, let's just say up 90 points. So what if we go up to 48.50, hypothetically? 48.50 would actually almost correspond to the low of last week. And therefore, the low of last week, I think, will be an important. I think the low of last week will probably be an important magnet. So, everyone's talking about doom and gloom with the market. But for me, I want to see more here. This could easily bounce. This is a problem for the bulls. And that's why I think that we'll probably get a pullback in some kind of lower high. But I don't, you know, I think that we're probably going to try and bounce tomorrow and create a bigger tail on this on the weekly chart. But we'll see. All right. Thanks everyone for tuning in, and we'll talk to everybody very soon. And hope everyone has a great night. Thank you.